On the morning of March 19, 2026, one of the largest financial institutions in the world watched roughly 1 lakh crore rupees, or over $12 billion vanish in a matter of minutes. HDFC Bank shares plummeted nearly 9% right at the opening bell, dragging the stock down to a 52-week low. This chart highlights the paradox of the morning's panic. Just weeks earlier, the bank reported an 11% year-on-year rise in net profit, pulling in over 18,000 crore rupees. The underlying business was thriving, yet the stock line sharply collapses against those healthy profit columns. There were no massive defaults suddenly discovered in the loan book, regulators hadn't issued any crippling fines, and the broader global markets were entirely stable. The bank's business model remained intact. This 1 lakh crore evaporation represented a pure, instantaneous collapse of market trust. To find the source of that panic, we have to look away from the spreadsheets and zoom in on the human element here on Dalal Street, India's financial epicenter. Before the market opened, HDFC Bank announced the abrupt, immediate resignation of its part-time chairman, Atanu Chakraborty. Leadership changes happen every day, but in his resignation letter, Chakraborty specifically cited internal practices over the past 2 years that did not align with his personal values and ethics. In finance, a quantified loss is manageable because it can be priced into a stock. Vague hints at internal ethical risks create an information vacuum. Investors assume the worst, and they sell first to ask questions later. What vanished that morning is known as a governance premium. It is a highly valuable, invisible asset that sits on top of every major company's balance sheet. Banks operate on public deposits and strict regulations, surviving solely on unquestioned trust. Every checking account opened is a trade in institutional reliability. Markets gladly pay a higher stock price for a bank when its top leadership is viewed as stable, ethical, and entirely transparent. When that glowing block of governance trust is removed, the total valuation crashes downward to match the raw underlying assets. Corporate trust is not a soft human resources metric. It is a hard, quantifiable financial asset that takes decades to build and seconds to lose. The fallout was immediate. Global financial firms like Macquarie quickly reacted to the governance concerns by stripping HDFC Bank from their marquee investment lists. This chart illustrates the Nifty 50 index, where HDFC Bank alone makes up nearly 12%. As HDFC's heavy slice pulls downward, it drags the entire national market with it, pulling the broader index down by nearly 600 points in early trade. Management scrambled to stop the bleeding. They immediately appointed former executive Keki Mistry as interim chairman to project stability and calm investor nerves. Even the Reserve Bank of India, the nation's central banking authority, stepped in to publicly confirm that the bank's operational fundamentals remained strong. But a fractured governance premium cannot be repaired with reassuring press releases. Once the market begins to doubt the ethics of the boardroom, the selling pressure takes on a life of its own. If you look at the physical footprint of HDFC Bank across the Indian skyline, especially after its recent merger, you see a sprawling financial conglomerate. Underneath the panic, thousands of branches are still opening accounts, processing loans, and generating daily profits. The actual machinery of the business hasn't stopped working. This timeline shows the stock's history over the last few years. You can see steep drops during the shocks of March 2020 and January 2024.
In every past instance, once the uncertainty cleared, the stock began a slow, steady recovery. Financial fundamentals eventually dictate the long-term price of a stock, but reputational damage severely delays that recovery timeline, forcing investors to wait out the uncertainty. For anyone buying shares in a mega corporation, this episode highlights a crucial blind spot in standard financial analysis. Spreadsheets and quarterly earnings reports are excellent at reflecting what a company has achieved in the past. They cannot calculate the future risk of human conflict. A company's leadership team is ultimately a volatile financial variable, and as the market learned on March 19th, it is a variable capable of erasing $100 billion in a single morning.